Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Rich Kimble. He's going to be talking to us today about the opportunity in private real estate. Hi Rich.
Hi, thank you for having me.
Can you tell us about Nuveen and the different asset classes that you look at?
Yes, happy to. Nuveen is a global investment manager with approximately 1.3 trillion in assets under management, investing across both public and private markets. We also are the largest alternative investors across the globe, investing in real estate, infrastructure, farmland, and timber. I'm part of the Nuveen Real Estate Group. We are a top 5 landlord, a real estate investment manager with about 140 billion of assets under management. We have real estate professionals across 30 different cities, including here in Sydney. We invest not only in the US directly in direct real estate, but both Europe and Asia. We're also able to invest in commercial real estate debt and also real estate securities such as listed REITs and CMBS.
Okay, so focusing on real estate, many Australians will be familiar with investing in the residential side, but what can you tell us about the differences within real estate as an asset class?
Yes, I think the great thing about commercial real estate is the variety in what you can invest in. There's so many different sectors and subsectors. You have the 4 main sectors: industrial, retail, housing, and office, but all of them have subsectors. For industrial, you've got light industrial, bulk warehouse, who behave very differently. Within residential, we have traditional apartments, but you also have senior living, student housing, single-family rentals. For retail, you've got your traditional regional malls, but you also have grocery-anchored centers and strip centers. Within office, the office sector is taking a hit, but within the subsector, you've got medical office, which is actually doing extremely well. So within all those different sectors and subsectors, I think it's very important to understand which sectors to underweight and which sectors to overweight, because that will provide that alpha or outperformance for your clients.
Okay, so what are the benefits of private real estate versus exposures like listed REITs?
So private real estate typically trades at its fair market value. So the attributes for private real estate is 1, stable income with the ability for long-term appreciation. Given that it trades at its fair market value, you have lower volatilities than equities and listed REITs. But to me, the most important aspect of private real estate is it's a diversifier. You have negative correlation to fixed income, very to any correlation to equities, and very low correlation to listed REITs. So if you had private real estate, it should increase your risk-adjusted return, given those low correlations. Also, being a real asset, it's a natural inflation hedge. I think the downside for private real estate, it's illiquid. You can't trade it daily. Listed REITs, on the other hand, are publicly traded companies. They're liquid. You can trade them daily. But you have to understand, you're buying a company, a publicly traded company that owns and operates real estate. So being that it's listed, you often see that they trade at big discounts to their NAV or sometimes premiums to their NAV. So you're not getting that true benefit of the private real estate. I think both belong in a portfolio. I own both personally, but I think it's really client-centric. If your client, if liquidity is the utmost important to your client and they like to trade, listed REITs are the way to go, or public REITs. If they want the benefits of that diversification, that natural inflation hedge, and they don't need liquidity or utmost liquidity, private real estate's the way to go.
Okay, so in one of your latest insight papers, you mentioned that the team is currently focused on the most dynamic segments of the private real estate market. If you could tell me, what are they and what are you avoiding?
Yeah, so maybe I'll start with what we're avoiding. I was fortunate for the fund I run. I didn't like office before the pandemic, not knowing that we'd change the way we'd work, but it's just a chronic underperformer, given the amount of capital you need to put into it. So we've avoided office, which has been a good thing in the US. What we like in the US, we continue to like light industrial. It'll continue to benefit from the growth in e-commerce. We're starting to see onshoring or reshoring in the US that'll draw demand. 2 sectors that are typically recession-proof or recession resilient are necessity retail, so grocery-anchored centers in the US. They've performed quite well over the last 18 months, so we like that quite a bit. The other sector that might not be on everybody's radar, that we like is healthcare real estate. So think of medical office buildings, outpatient centers. It's really benefiting from really strong tailwinds, given the aging baby boomer population and very little supply. So that sector it's at its lowest vacancy ever with very little supply coming online. So we like that sector quite a bit. That's a big differentiator for us. Within housing, we've seen quite a bit of supply in the U.S. So for our fund, we haven't bought an apartment building in almost 4 years in the U.S., just given the amount of oversupply we've seen. But I'd contrast that to here in Australia. We do like housing quite a bit, traditional housing, given the increased population, limited supply. I think the fundamentals are really strong there. We also like student housing here in the primary cities, really benefiting from increased enrollment, plus benefiting some policy changes or restrictions in the U.S. If I look at Japan, we like our traditional apartments in Tokyo and Osaka. We also like senior living in those two cities, given the aging population there. And then in Europe, we like housing. We're underhoused in certain cities in Europe. We also like student housing in the UK. We like industrial in Germany. So a wide variety to pick from, also some sectors to stay away from, at least temporarily.
You say that in housing that the highest quality asset doesn't always correlate to the highest return on investment. Can you tell us what you mean by that?
Yeah, so I think it's all about the basis that you buy an asset in and how that fits in within the market. You can buy the brand new luxury apartment building that looks great on the brochure, but if you're buying that and you need to achieve maximum or the highest rents in the market, you're probably not going to outperform. We like kind of that middle market, that A- property, B plus, where your rents are fairly below that luxury end, so you have the opportunity to push rents over time, which is going to give you that outperformance. But I think most importantly, when you're looking at real estate, it's how that property fits within its market. Every deal I look at, I assume the tenant is going to leave at some point, and I want a property that I know I'm going to be able to refill that tenant and push rents.
Mm-hmm. Yeah. So how do you manage liquidity risk in private real estate?
Yes, so I think the most important part of liquidity risk is managing your balance sheet. I was on a fund that had daily liquidity within real estate back during the global financial crisis and learned quite a bit. That was a very tough time, not enjoyable, but you learned quite a bit. The funds that failed at that time didn't have real estate issues, they had leverage issues. So I think it's important to manage your balance sheet, have cash or have liquid assets you can move, but most importantly, manage your debt. Debt cuts both ways. Within the fund I manage, we brought our leverage down in 2022, which helped us quite a bit, both managing liquidity, but also helping out with our returns.
So we all know there's a lot going on in the world right now in terms of macro and geopolitics. How is private real estate set up to weather this macro uncertainty? If you can share maybe some anecdotes that you have.
Happy to. I would say real estate's not immune to all these macro issues that we're dealing with, but I think there's a number of things that real estate has going for it. One, we've taken our pain. We're down about 20% from peak. We're entering a new cycle, so we're entering the recovery phase, so it's a great entry point. While there's a little uncertainty with demand, with those macro issues, supply is under control. We're going to see limited supply in real estate over the next 3, 4, 5 years. That's really going to benefit us. If you look back to 22, when both equities and fixed income were down quite a bit, real estate was actually up. So it did its job being that diversifier. So I think you combine that with it being an inflation hedge, low volatility, and being at a great entry point, I think there's a case for commercial real estate today.
So finally, many of our investors invest across multiple asset classes via a broadly diversified portfolio. What role do you see unlisted global real estate playing in a portfolio that may already contain global shares and listed real estate trusts?
Yes, I definitely think it belongs in a portfolio, given that stable income you receive with the upside for long-term appreciation. I go back to it being just a strong diversifier, negatively correlated to fixed income, very low correlation to equities, low correlation even to listed REITs. Combine that with the entry point in that natural inflation hedge, I think there's definitely a case for commercial real estate.
Okay, great. Thanks, Rich,
Thank
for
you so much.
sharing your insights with us today, and enjoy the rest of your time here in Australia.
Thank you.
If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel where we release new content every week.